problem say? So this problem says BE 44, or no, we're doing 45. BE 45 on page 444 says, Leahy Advertising Company's trial balance at December 31 shows supplies $8,800 and supplies expense $0. On December 31, there are $1,100 of supplies on hand. Prepare the adjusted entry at December 31 and using T accounts, enter the balances in the accounts, post the adjusting entry, and indicate the adjusted balance in each account. Okay? So this is what we are going to do. So when we are doing anything with supplies, the key number that we are looking for is what was used. What was used. And how you get what was used, the problem is either going to tell you what was used or it's going to tell you what you started with. And so for this problem here, we started with 8,800. So we started with $8,800, okay? We ended with $1,100. So that means if we had $8,800 to start with, and now we only have $1,100, we're going to subtract the $1,100 from the $8,800, and that's going to give us $7,700. So that means we used up $7,700. So 7,700 is what we used up. So whenever we're doing the entry for supplies expense, we are going to debit supplies expense and we're going to credit the asset supplies. So this is December 31. We're going to debit supplies expense. What we used, 7,700. And we're going to credit the asset supplies because we no longer have those supplies on hand. We've used them up. Okay. All right. So now they're also asking us they want us to do what the T account balances are for these. Okay. So first we have to put what it was when it started. Now, this is a very important thing to note. Your starting balance in your homework and on your exam on these is going to be, so this is December 31, it's going to be balance 12/31, and then our starting balance in supplies was 8,800, right? 8,800. Now, I'll explain the date in a second. So the balance was 8,800. Then the supplies expense, there was nothing in the supplies expense in the beginning. It said it was $0. Okay. So we're now going to post these entries to the account. So we're going to debit supplies expense 7,700, and debit's on the left side, remember? So 12/31, we're going to debit supplies expense 7,700, and we're going to credit supplies 7,700. All right. Then they want us to balance the accounts. So supplies expense is a debit balance of 7,700. Yeah, we've never used the date before, but I'll tell you why we're using the date in 1 second. Okay. Then supplies is going to be 8,800 minus 7,700, because remember we subtract the smaller side from the bigger side. We also know supplies is an asset. Assets have a debit balance, so we know that the balance is going to be on the debit side. So we're going to put balance 12/31, 7,700. Now, the reason why I'm mentioning the date here is that you'll see it says balance 12/31 and then balance 12/31, because technically this happens on the same date. What happens is you do all of your entries for the month, and we know it doesn't actually happen on the 31st. It happens a couple weeks later. It takes us that long to get all the entries in, right? But we do all the entries for December in our journal entries, right? We analyze the transaction, do all those. We balance all our T accounts. We do the trial balance, right? And the trial balance is coming from, oh, not that one. It's the trial balance is coming from the, if you can see the screen, the yellow, right? So the trial balance was 8,800 for supplies. And then I'm going to move this down here. And then the supplies expense was 0. Okay. So you then do your adjusting entries on the same day, on December 31. So that's why once you do your entry and then you do the balance, your adjusting entry balance, now this is the total in green, if you could see that, is also 12/31. So it's all done on the same day. You balance your T accounts, you do the adjusting entries, and then you balance your T accounts again. So the important thing to remember on this for your homework and for the exam is that you have to have the same date, 12/31, for the start of the balance and the end of the balance. Okay. So that's the example for 4.6 for supplies. Let's see. All right. So now let's go on to exercise 4.6, BE 4.6. So BE 4.6 says.
Oh my God.
All right. So we are now going to do BE 4.6. Okay. So BE 4.6 says, at the end of its fiscal year, the trial balance of Rayburn Company shows equipment $22,000 and 0 balances in accumulated depreciation equipment and depreciation expense. Depreciation for the year is estimated to be $2,750. Prepare the annual adjusting entry for depreciation at December 31. Post the adjusting entry to T accounts and indicate the balance sheet presentation of the equipment at December 31. All right, so first thing we're going to do is we're going to post the depreciation. Now it says annual depreciation, and they've told us that the depreciation for the year is estimated to be $2,750. So that's it. We don't have to do any math. They gave us the number. They gave us the number there. So it's going to be December 31 is the date. And whenever we're doing the depreciation adjusting entries, we are debiting depreciation expense. And the amount that we're debiting depreciation expense is $2,750. And then we're crediting accumulated, accumulated depreciation hyphen equipment. Because it said it was equipment. And that is the same amount. We're crediting $2,750. So that's the entry, right? Okay. And then they want us to show what the balances were. So they told us that depreciation expense was a balance of 0, right? And accumulated depreciation. So both of them were zeros to start with. Okay, so we've got, we're going to debit depreciation expense on 12/31. We're debiting depreciation expense $2,750. And then we are going to credit accumulated depreciation equipment $2,750. Then we're going to balance the account. So for depreciation, we're going to have balance 12/31. It's going to be $2,750. And then it's the same balance on the credit side for the accumulated depreciation. Okay. And then we are going to show what the financial statement would look like for equipment. Oh, they want the T account. Do they want the T account for equipment too? They do not want the T account for equipment. They just want to see the balance of the equipment. So let's see. Accumulated depreciation is always a credit. Yes, it is a contra revenue. So it's always a credit account. Hold on one second. Okay, so they want us to show the what the financial statement would look like. So what it would look like is we would have equipment. And the equipment they said cost $22,000. And then below it, we would have less accumulated depreciation. Equipment. I obviously need a wider spot there, huh? And that amount, hold on, I gotta adjust this because I'm actually gonna move this over here so that it's easier for you to see. There we go. The accumulated depreciation equipment would be $2,750, right? And then we would subtract the $2,750 from the $2,200. And so on the financial statement, it would show $19,250. Okay, $19,250. So that would be what it would look like on the balance sheet for the equipment. All right, so let's go to item number, let's go to BE47, okay? And in blue there, I have some stuff that I'm gonna kind of go over with you because this has to do with figuring out the length and everything. So be patient with me here on this while we work through this. All right, so 47 says, on July 1, 2022, Ling Company pays $12,400 to Marsh Insurance Company for a 2-year insurance contract. Both companies have fiscal years ending December 31. For Ling Company, journalize and post the entry on July 1 and the annual adjusting entry on December 31. So the first entry that we're doing is when we bought the insurance on July 1, okay? So July 1, so what did we get? Well, we got an asset called prepaid insurance. Prepaid insurance. And it was $12,400. Not 200, $12,400. And well, it says pays or paid. So anytime it says pays or paid, that means cash is involved. And since we're paying, our cash is going down. Cash is an asset, has a debit balance. So to make it go down, we're going to credit it. So we're going to credit cash $12,400. So that would be the entry that we make when we buy the insurance policy. Then they want us to do the adjusting entry. Now for the adjusting entry, they tell us that it is a 2-year policy, right? So the way that you figure this out is a little different than you might think. And I'll tell you the reason why. Now we have a nice round number here, 12,400, right? Ends in a 0. So your first instinct is going to be, oh, okay, I'm going to take the 12,400, it's for a 2-year policy, which is 24 months, right? And I'm going to divide 12,400 by 24, and that's going to tell me how much per month, right? And then I'm going to multiply that by the number of months that have passed. Because if you look at this problem, we bought the insurance policy on July 1. We're doing the entry on December 31. So that means that we're doing the adjusting entry at the end of the year, and we need to do the adjusting entry for all of July because it started on July 1, all of July, August, September, October, November, and December. So 6 months. So your inclination might be to take the 12,400, divide it by 24 months because it's a 2-year policy, and then get that number and multiply it by 6. That's not how you do it in accounting. And the reason why you don't do it that way is because if you have something that ends in an odd number, like say it ended in a 3, like 12,403, and you did it that way, you would end up with some change. And if you rounded up, it might be enough to be $1 off and it would be wrong. So this is the way you do it. Okay. You take the amount and you're going to multiply it by a fraction, and you're going to turn that fraction into a decimal. Okay. So the numerator, the top number, is the amount of time that you're doing it for. Okay. So in this case, it's the time from purchase to the time of adjusting entry. Okay, so if you look up here, I've got something over 24, right? The denominator is the length of the policy. The top is something or the time from purchase to the time of adjusting entry. So that's 6 months, all July, August, September, October, November, December. So it becomes 2,400 times 6/24. But you need to get that 6/24 to a decimal, so you divide it, right? So now you 1224 times 0.25. Okay, 12,400, not 1224, sorry. 12,400 times 0.25. And I'm just putting this like this, times 0.25. That means that you used up $3,100 worth of the insurance in that 6 months. Now, this is an even number, so if you did it the other way, it would work. But if it was not an even number, it wouldn't. And you should get in the practice of using this approach, because we will have other things that come up where you have to do the same type of thing. So $3,100 is the amount of insurance that we've used up. And so when we use up the amount of insurance, what we're going to do is we're going to December 31 is the adjusting entry date. We're going to debit insurance expense for the amount of insurance that we used up, which is $3,100. And then we're going to credit the asset prepaid insurance, because assets have a debit balance, right? So when we credit it, it's going to make it go down because it's not an asset anymore. We've used it up. Okay. We're going to credit prepaid insurance, $3,100. Now, I just realized I don't have my T accounts here. So let me do my T accounts here. So we've got prepaid insurance is one T account, right? The other T account is going to be insurance expense. We would have a T account for cash too, but I'm not going to put that one on here. Okay, so we are going to, on July 1, we're going to debit prepaid insurance. July 1, we're debiting prepaid insurance, 12,400, right? And we would credit cash, 12,400. I should probably put that on here. I'm going to put cash over here. We would credit cash, 12,400. 12,400. Okay. And then that would be this entry here. Then on December 31, we are going to debit insurance expense, $3,100. So 12/31, we're debiting insurance expense, $3,100. And then on 12/31, we are going to credit prepaid insurance, $3,100. We're crediting prepaid insurance, $3,100. And then we need to balance those. So to balance those, we're not going to balance the cash because that's really not an accurate cash account, T account. I'm just going to take it off. So over here, we're going to balance the insurance expense. Our balance would be, balance on 12/31 would be 3,100. Oops, 3,100, not 3.10, 3,100. And then for prepaid insurance, we're going to subtract the smaller side from the bigger side, right? So it'd be 12,400 minus 3,100. And do you see that I made a mistake? What is my mistake here? I don't know. What was my mistake? Did I make a mistake? No, I did not make a mistake. I did that correctly. Okay. So 12,400 minus 3,100 would be 9,300. So our balance on 12/31 would be $9,300 for the prepaid insurance account. And I've got a funny number there. Let me fix that number. Okay. So that would be $9,300 for that one. Okay. So that is the one for BE47. Now I had BE48 linked to this because when we learn the other side of the transaction, we're going to be the seller of the insurance, but that's going to be what we cover on the next class meeting.